Welcome to Tech Money Madness, your daily U.S. stock market podcast, August 21st, 2026. If you are looking at your screen this morning and wondering how the market can, simultaneously look like a textbook success story and a looming disaster, you are definitely not crazy.
No, you're really not.
Yeah.
It's a very weird day.
Right. I mean, imagine driving down the highway, you look down at the dashboard, and the speedometer says you are cruising at a perfectly safe 65 miles per hour. The engine temperature gauge is dead center, but you roll down the window and you can smell burning rubber.
Oh yeah, and there's just thick, acrid smoke pouring out from the rear tires.
Exactly. That is the exact macro environment you are navigating today in this deep dive. The dashboard is our consumer inflation data, which is cooling off beautifully, but the smoke billowing from the back of the car is the U.S. bond market, which is currently flashing some very serious warning signs.
It really is a fascinating moment, honestly. We're seeing a complete breakdown of the traditional economic playbook here.
We really are. So our mission for today's deep dive is to untangle this massive disconnect. We are going to look at why a government bond buyback completely backfired and how the tech sector is stepping in with a staggering $500 billion financing trick to fund the AI revolution.
Which is just a massive number.
$500 billion, yeah. And we'll get into why the smartest money on Wall Street is treating tech behemoths like they are the new sovereign safety trade. Plus, we have to look at a bizarrely mixed July jobs report that basically mathematically contradicts itself and leaves the Fed completely boxed in.
The old correlations where, good news on inflation meant a green light for bond markets, those are simply breaking apart right now under the weight of some massive structural shifts.
Yeah, so let's get right into that breakdown, starting with Friday's mixed close. Because the paradox is just glaring. If we just look at the headline inflation numbers, the Federal Reserve should be taking a victory lap right now.
They should be.
July CPI rose just 0.1% month over month. That brings the annual rate down to a very manageable 3.4%. And on the wholesale side, the PPI was completely flat, zero growth.
Right. And historically, if you get a flat PPI and a cooling CPI in the exact same week, you would expect fixed income markets to, throw a massive party.
Yeah, bond yields should be dropping like a stone.
Exactly, because the market would be pricing in an aggressive series of rate cuts from the Fed, but that is absolutely not what happened.
No, the bond market is basically throwing a tantrum instead. Treasury Secretary Scott Bessent tried to step in this week to stabilize things with a Treasury buyback operation. They targeted over $4 billion of long-term government debt, hoping to calm surging yields.
Which completely backfired.
It totally backfired. The break-even inflation rate, which tracks where the market thinks inflation is heading, it just spiked to its highest level in over 2 months immediately after that intervention.
Yeah, and to understand why that intervention spooked the market so aggressively, we have to look at the mechanics of what a Treasury buyback actually signals to institutional investors.
Okay, break that down for us.
So normally, a buyback is a tool for market plumbing. The Treasury buys back older, less liquid bonds and issues new ones just to keep the trading gears turning smoothly. But when long-term yields are surging and the Treasury suddenly steps in as the buyer of its own debt, the market doesn't see a plumbing fix.
They see panic.
Right, they see panic. It highlights vulnerability. $4 billion is a massive amount of money to a normal business, but in the context of the U.S. bond market, it's barely a rounding error.
Right, so investors are essentially looking at the Treasury and saying, well, if the government has to be the buyer of last resort for its own bonds, the organic private demand must be evaporating.
Exactly. The intervention proves that the sheer scale of debt issuance required to fund the government is just starting to overwhelm the system's capacity to absorb it.
But I want to push back on the inflation piece of this for a second. Because if you look at alternative metrics like the trimmed mean indicators, which toss out the wildest price swings to find the true underlying trend, inflation is actually sitting at multi-year lows.
It is, yeah.
So if the core math of consumer prices is actually that good, why would a relatively small targeted government buyback push inflation expectations to a 2-month high?
Because the bond market is no longer just pricing in what happens at the grocery store, right? It's pricing in the reality of fiscal scale. It's pricing in supply.
The structural reality.
Exactly. We're no longer dealing with a normal debt load. The supply of new government bonds is relentless, regardless of what consumer prices are doing.
And that perfectly brings us to the macroeconomic anchor that is dragging on everything else today. The U.S. government debt has officially surpassed $40 trillion for the very first time.
Which is just a staggering milestone.
It has more than doubled in just a single decade. And to add fuel to the fire, the budget deficit for July surged to its highest level since March of 2021.
And this is exactly why Bessent's intervention failed. He's been on the wires recently, projecting optimism, stating there is a very good chance the U.S. budget deficit has finally peaked under the current administration.
Right.
But the bond market is doing the math on $40 trillion of principal. When debt reaches that scale in a higher rate environment, the interest payments alone become this self-sustaining driver of future deficits.
And we also need to note the political pressure cooking underneath this, impartially speaking, of course. President Trump has been highly critical of the Federal Reserve's interest rate policy this week.
Yeah.
He's arguing that the U.S. should be paying significantly less to service its debt and accusing Fed officials of having political motives for keeping rates high. Just to be clear, we're simply reporting on the viewpoints contained in the original source material here, not taking sides. But it adds a ton of pressure.
Oh, absolutely. And setting any political motivations entirely aside, from a pure market mechanics standpoint, that kind of rhetoric perfectly illustrates the trap the central bank is in right now.
Well, they control the short-term policy rate to fight inflation, but long-term rates are governed by market confidence and debt supply. If the central bank cuts rates aggressively to lower the government's borrowing costs, the bond market might view that as abandoning the inflation fight.
Which would paradoxically cause long-term yields to spike even further.
Exactly. So the core tension today is this cooling consumer inflation versus deepening bond market distress driven by sheer fiscal scale.
So if you are an institutional investor, right, you manage billions of dollars, and you are watching the $40 trillion sovereign debt market wobble, you need a safe place to park your capital.
They definitely do.
And while the bond market is struggling, institutional investors are seeking safety in very specific cash-rich tech behemoths. The tech sector is executing its own massive financial restructuring.
It really is.
Let's talk about NVIDIA, because what they just announced is a landmark $500 billion artificial intelligence infrastructure financing plan. They've partnered with an absolute who's who of Wall Street titans.
BlackRock, Blackstone, KKR.
Yep. Apollo Global Management, Brookfield, and Goldman Sachs. $500 billion. So they are basically pivoting from just a pure tech build-out into deep financial engineering.
It fundamentally changes how we need to value the company. Up until now, NVIDIA's business model was, relatively straightforward. Design the most advanced chips in the world and sell them for massive upfront cash to hyperscalers building data centers.
But that requires the buyers to have bottomless pockets for capital expenditure.
Right, which is a huge credit risk and a bottleneck. So to remove that, NVIDIA and this Wall Street consortium are introducing inferencing as a service. They want to securitize AI compute assets.
I love this analogy we were talking about earlier. Think of it like the commercial aircraft leasing industry.
Yes, exactly. Airlines rarely buy fleets of jets in straight cash. A massive financial leasing company buys the jets, and the airline rents them. It turns a huge capital expenditure into a smooth operating expense.
So Wall Street is now acting as the leasing company for AI data centers.
Exactly. The compute power itself, the servers, the GPUs, becomes the underlying asset of a financial product. This expands their ecosystem way beyond just the mega-cap hyperscalers.
So NVIDIA is no longer just selling the pickaxes for the AI gold rush. They are now acting as the bank financing the entire goldmine ecosystem.
That's a perfect way to frame it. And let's look at the valuation context here, because NVIDIA has delivered a staggering 1,440% return since 2023.
Just insane numbers.
But despite that, they're currently trading at 34.5 times earnings. Because their earnings have grown so fast, the valuation is remarkably grounded.
It signals the maturation of AI, right? It's moving from a pure technology narrative into a Wall Street financing story, which perfectly bridges into our next story, tracking where the institutional titans are actually putting their money.
We are seeing historic concentration by the smart money.
Let's look at Peter Thiel's hedge fund, Thiel Macro. In the second quarter, they just made their largest single stock purchase in the fund's history, a $118 million investment strictly into Amazon.
Wow.
That one position now makes up 28% of their entire portfolio.
And that isn't a bet on e-commerce. That is a bet on the AWS engine. Amazon Web Services saw its growth accelerate to 37% in Q2.
Backed by a...
It really did.
So I have a direct question for you on this. Is this historic concentration by Berkshire and Thiel a sign of absolute, unwavering conviction in AI? Or is it a signal that they see literally nowhere else safe to park capital in this macro environment?
I think it's the latter. It's a flight to safety. When the U.S. Treasury is struggling with $40 trillion in debt and the bond market is volatile, a cash-printing monopoly like Alphabet or Amazon genuinely looks like the safest asset on Earth.
Finding safe havens is critical right now, especially because the broader economic data is sending entirely contradictory signals. Which brings us to the bizarre July jobs report.
That report is the definition of statistical cognitive dissonance.
It really is. So the U.S. economy unexpectedly lost 23,000 jobs in July. Forecasters were expecting a gain of 83,000, so a massive miss.
A huge miss.
But in the exact same release, the national unemployment rate actually fell. How does a country lose jobs but end up with lower unemployment?
It comes down to two completely different surveys. The loss of 23,000 jobs comes from the Establishment Survey, where they poll businesses. ADP private hiring also came in weak at just 44,000 workers, mostly in healthcare.
So the establishment side shows real weakness.
Right. But the unemployment rate is calculated using the household survey. What we saw was a drop in the labor force participation rate. People simply stop looking for work, so the total pool shrinks, and the unemployment rate artificially ticks down.
So under the surface, the labor market is absolutely cooling off, and second quarter GDP growth slowed down to 1.5%, dragged by declining federal spending and inventories.
Which normally would give the Fed the green light to aggressively cut rates.
But simultaneously, manufacturing purchasing managers are reporting that inflation worries are currently, quote, worse than the pandemic era.
And that is exacerbated by the cost pressures of the very AI infrastructure build-out we were just talking about. The demand for raw materials to build data centers is creating localized inflation.
It leaves the Fed completely trapped. They are caught between a slowing labor market on one side and sticky manufacturing inflation on the other.
They are totally boxed in.
It's like a pilot trying to land a plane in a storm. Half the dashboard instruments read dangerously high and the other half read dangerously low, and you just don't know which gauge to trust.
That is exactly what they're dealing with.
All right, let's take a quick spin through our market movers. Unsurprisingly, NVDA and Amazon are the notable gainers of the day, based on the financing and hedge fund news.
But under the surface, there is a fascinating valuation showdown happening.
A value rotation.
Yeah, look at Bloom Energy, ticker BE, versus Palantir. Both of those stocks are up over 1,000% in the last 3 years. But Bloom is catching attention at a much cheaper 14 times sales.
Versus Palantir's 50 times sales.
Exactly. And Bloom has a 70% revenue compound annual growth rate and a $20 billion backlog. It really highlights how smart money is rotating toward better near-term valuation in the AI space.
Also on the radar in retail tech, Walmart is officially rolling out Tap to Pay at the register starting August 24th with Google Pay. Apple Pay is expected to follow. And finally, Wall Street analysts predict that Microsoft and Taiwan Semiconductor, TSM, are on track to join the $4 trillion market cap club by 2028.
Just staggering numbers across the board today.
It really is. So let's rapidly synthesize all of this for you. The overarching theme is that cooling headline consumer inflation is actively being overshadowed by the sheer scale of the $40 trillion fiscal debt and bond market anxiety.
And because of that, AI has officially matured. It's moved from a pure technology narrative into a Wall Street financing story.
Right. And looking forward, what you need to watch next is how the Fed navigates being trapped by this contradictory data, while institutional giants continue to build fortresses and proven AI leaders.
It's going to be a very bumpy landing.
Definitely. I want to leave you with one final provocative thought to mull over today. With NVIDIA turning AI into securitized financial products and U.S. debt crossing $40 trillion, we might be entering an era where mastering financial engineering is just as critical to tech dominance as the algorithms themselves.
Absolutely.
That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.